Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you.
Mike, the markets, how would you characterize them right now?
Well, this has been a real interesting year. I think it's going to take as many people as it can by surprise. And the thing is, short term, over the next 6 months, let's say, I'm probably more bullish than most people. Now, I was bearish last year every single month. When the market would have the rallies, I would say the rallies were fake. Don't be fooled by them. What happened was in 2021, the internals of the market, and we talked about this together actually, but they formed a negative divergence and fell while the market averages went up. What this meant was that more stocks were going down than up, even though that wasn't readily apparent if you just looked at the NASDAQ, because it was being helped by the big cap tech stocks pushing that higher. And this had always been a warning sign that you're headed for a bear market, and so we got it last year. But the positive thing for the market is that these internals have turned up. There's more stocks that have been going up and going down beginning in November, and that's not something you really see in a bear market. So it's kind of a funny situation. I would say we're in a secular bear market, which is a long-term, bear trend. Speaking of 10 years or more, we saw that from 2000 really to 2009, even though the market did have a good rally from 2003 to 2007, but most stocks didn't ever go through the highs of 2000. In the 1970s, there was a cyclical bear market that really began in 1967, lasted to 1982. But within these long-term, 10-year or longer phases, you can get shorter-term cyclical bear or bull markets. So I think we're in a cyclical bull market, and the shortest they last is 2 years. And if we think it started in November, that would imply that the market can be relatively healthy, let's say okay, until the next presidential election passes. Doesn't mean we're going to make new highs, but I think overall the trend is sideways to up for the U.S. stock market averages. I wouldn't be shocked if the S&P doesn't get to 4,800 at some point. It doesn't mean, so I'm a little more optimistic than most. I guess you could say I'm a believer in this rally. That said, the market is now overbought. With daily indicators that I use, the stochastics are overbought. The RSI is overbought. And so it's likely to, and it's been overbought now for 2 weeks. So it's likely to continue to do what it seems to be doing over the past several sessions, and that is go sideways. Maybe pull back a little bit. I would say support is at 4,000 for the S&P 500. Now, if we push the U.S. stock market to the side, the reality is we're in a global financial system, and stock markets around the world, they turned up in November and December, and they're doing better than the U.S. stock market. The European markets are doing much better. They're just almost going up at twice the rate. Gold and silver are doing better, outperforming the S&P 500. So I mostly speak to Americans, and all they want to hear about is the U.S. stock market. But the reality is these other markets are probably better investments to be making. They're just outperforming. They're going to continue to likely outperform. And one reason why is if you look at the U.S. dollar index, it made a peak in September, and it's below the turn-day moving average. It bounced over the past couple sessions, but that bounce is probably pretty much played out. Gold pulled back likewise because it tends to trade opposite to the dollar, but probably the pullback in gold is, from a price perspective, is probably, it's pretty much seen its course. Support, I would say, is 1850 now on gold, where the 50-day moving average is. Probably gold's going to go sideways here and break out in a couple months or so. So right now, to me, everything looks like short term, it's going to go sideways pretty much. All markets kind of look like that, and I think we'll end up seeing further rallies at some point. It may take a couple months before that develops, but I think that's where we're at. But if I look further out than than this so-called cyclical cycle, I wouldn't be shocked. At some point the U.S. when this rally does, this cycle ends, we'll probably see new lows in the market, in the U.S. stock market. That is the economic. When I say these things, people about the market, possibly going sideways up into the presidential election, people find it hard to believe because the economy is so weird. You can find signs of weakness, but you can also find signs of strength. Consumer spending, hasn't really gone negative. Unemployment for now remains low. People are spending money. People are traveling. People are willing to even take on credit card debt in order to do things. And they're not tightening their belts at all. And that's where we are. The inflation, I don't think is really going to go away, but the rate of inflation is coming down, and that's something I think the bulls might focus on. That's kind of the watchword now, is disinflation, much as transitory was in 2021. Transitory proved to be a lie, but it was a word used by the Fed, used by the Biden administration in 2021, that people believed, and they believed for a long time, and the market was okay. And I think many people will turn into believers of disinflation over the next couple months, and that will help them, be buyers of stocks. But, in the end, I think inflation will come back. It just might be a year before that happens. But, it's hard to predict that far out. But it's an interesting time that we're in, that's for sure.
Well, yes, there's that Chinese curse. May you live in interesting times.
Indeed.
That's how we make a living. We talk about those interesting times. Without them, the stock market would just climb at 2% a year, and nobody would have a money problem, and no one would ever lose money again. But that's not the real world.
That's what I told. No, but that's what I was told the market was about. When I started trading in 1999, I was told that all you had to do was buy internet stocks, and you would be able to get rich and never have to work again at some point, and probably soon. And the funny thing is, a lot of people were fed that same thing and believed it when it came to meme stocks, crypto, Robinhood trading, and those are the people that got caught, suffering the most in this downturn that we had last year. But there are factors that are, troubling. We're not heading for some, we're not going back, even though, I believe I'm more optimistic than most on what the market could do this year. We're not going back to the way things were before 2022. And that's where some people may believe that, and or at least they still act like that. There has been a rally in these meme stocks. There's still many believers in crypto, but one of the biggest things that I think demonstrates, maybe perhaps the biggest thing, is interest rates. We saw interest rates go to zero in 2020, and they'd never been at zero before in the United States. We never had negative yielding debt either that we saw in a couple years before that, and all that came to an end. No more negative yielding debt anywhere. And that was a moment in human history that's probably never going to come again. It certainly won't come again in our lifetime, and therefore we're never going back to the way things were. And one thing that's different now, too, and you mentioned it to me before we got on the air, was the yield curve's inverted. And as you pointed out, that is the most accurate indicator of a recession. The thing is, we know one's coming, but we don't know when. We just had, a jobs report that said 500,000 jobs are created, about twice as many as were expected to have been created in January. And the GDP growth is still positive. It's difficult to predict the exact timing of these things. There are signs of sectors in recession. There's no doubt about that. The tech sector is a debacle. They are having to lay off, thousands of employees at Google, at Amazon, at Apple, at Microsoft, all these Silicon Valley tech companies. Robinhood laid off last year. Coinbase, all those tech wonders companies, it's layoff central. But restaurants are still desperate to hire. There's a nursing shortage. Services industry has shortages. Pretty much all over the world, the Western world, this is what is going on. And the yield curve inversion, we could get the recession next year, maybe a year after, or maybe in 6 months it could start. I don't really know. But in 2005, 2006, the yield curve inverted, and the recession blew wide open, really starting in the first half of 2007, but it wasn't evident to people that there was a recession until 2008. So it's 2 years. And then in 2018, the yield curve got near inversion, and then 2019, it inverted, and it wasn't really till a year later, almost 12 months, that the shutdowns and lockdowns happened, and that recession took place. So it can be a year until it happens, but we'll just have to see. But the stock market can rally or be okay, I should say, until it's completely obvious that there is one. And I'd say I'm more optimistic than most on the markets. From here, move up to the high on the S&P 500. It's not a huge move. You're talking, just a little bit around not that much higher than 10%. So it's really critical to be well diversified, more than ever. Gold and silver, I believe, play a key role in that. People should take note that last year gold fell less than the stock market, barely at all, when the year was over with, and then rallied stronger than the stock market on this rally. When the stock market crashed in March of 2020, gold fell half as much as the stock market and came back quicker. Gold is what is, it's a safe haven, and the dollar appears to have topped out too. So, people really need to take a hard look at gold mining stocks. They want to speculate the junior mining stocks. And as I said before, I'm a real believer in also investing outside the United States, maybe outside Canada, into European markets and then elsewhere.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're talking with Mike Swanson. What's your outlook on crude?
Well, we've been thinking crude's or I have. We've seen a pullback in crude since June. It went to 120 and it fell into December down to 70. And I was surprised at the extent of that pullback, but the pullback coincided with the pullback in gold and silver and commodities in general. It may not be completely over with crude, but I don't think there's much more real downside from here for it. So I think energy stocks are good buys, especially because they pay really nice big dividends, So I think it's a sector worth getting involved in. Really, when I look at what the leading sectors have been since, say, Labor Day last year, a lot of them are big dividend-paying sectors. Minerals and metals stocks, such as Southern Copper, they tend to pay big dividends. Even coal and steel stocks went up. Since October, bank stocks and REITs have been going up, and they tend to pay pretty good dividends. So, as I said, we're not going back to the way things were before 2022. When you have a zero interest rate environment, money becomes strange. Someone who has a lot of money in their bank account, it feels like they owe nothing. If they don't spend it, how do they invest it? They can't get safe dividends. They can't get yields, and they're forced into speculation. So that was part of the reason, I believe, that we did see crypto go up. We did see meme stocks go up. And, wonder plays and theme ideas, the electric car, and now look, Rivian is a debacle. Ford was one of the main investors in Rivian. They just sold every single share of that thing because it's a money loser, and it's not the only electric vehicle play in the world, and Ford can do their own. And the speculators who bought into Rivian, they wrote a stock that was trading at $180 and fell below 10. So complete disaster, and it can't make money. What makes money now aren't those kind of fad plays, but companies that have stable or growing earnings and pay dividends. When you have the three of those, you're investing in something real, not a flash in the pan. And if we do have a recession, at some point we will, the inverted yield curve suggests that, it is those sources of stability which are easier to use to navigate those environments. Companies that have stable earnings during recessions, their stocks tend to do better, and the speculative stocks completely crash. So while I'm more optimistic than most on this market rally, that doesn't mean I'm optimistic on the type of stocks that people that have Robinhood accounts own. You load up the Robinhood account, and they own garbage. Rivian, they still own it. Zoom, these kind of companies that don't have growing or stable revenue streams. Energy stocks do. Oil is not going to collapse to $20 a barrel. We're not going into a situation of lockdowns and shutdowns and all this kind of stuff. Well, maybe energy can pull back to $65 a barrel. I mean, it's trading around 80, but the thing about energy is seasonally it tends to go up now into July, and then, digest those gains or have a slight pullback into November or December. Probably what will happen again. So it's an interesting, thing to have in your portfolio.
And of course, Mike, every spring there's a refinery explosion or fire that dramatically boosts prices because then there's a shortage.
Saudis will do what they have to do to keep the price up. If they have to, they'll have an incident with Iran or something. They'll have a weird boat attacks or some weird thing will happen.
A drone attack on some Saudi refinery. That happened.
Yeah,
that happens
something
now.
will happen.
Yeah.
And in the end, this unfortunately, there's no sign that this war in Russia is going to end this year. So
I just wonder who makes all the artillery shells. They use thousands every day. Who's making the artillery shells? There must be some money there.
Oh, there is. You better believe it. The defense companies in the United States, Canada, Britain, they're making a killing.
Mike, anything else we should be keeping a close eye on?
Well, between now and the next time we speak, which is usually every month, a couple of weeks, 3 or 4 weeks, I really don't expect much is going to happen one way or the other. I think we'll probably see pretty much a drifting sideways market. Maybe gold, let's say, trades between 1850 and 1900 or something, or 1925. So I think that's pretty much what we're set up for.
Mike, thank you so much for chatting with us.
Thank you. Great talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. We'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.